Hello everyone, and welcome to another exciting day in the world of global financial markets and economics. We have had some key economic data out. We started with, in the US several hours ago, US retail sales, a very good number, up 3.8%, but that follows on a lot of ground to be made up after dropping 2.5% previously and only having a modest 0.7, a good reasonable 1.8 there. The average of the last 3 months is about 0.7%. That's good, but it's not exciting, and it's certainly not in the dimensions of this kind of expectation of a gain as per the first wave, and again kind of mega strong economic data, boom, recovery, boom phase outlook for the US economy, which we always argued against when everyone else thought that would be happening. At ACY, we've always argued against that view, and we've been proven correct. So nevertheless, though, that is a nice number to see for retail sales, and we'll see what happens there. In Asia today, we saw Japan exports, and there's still a reasonably good number. I mean, who would not want exports to be up 9.6%? But remember, it's still this volatile data series coming off low bases, coming out of the pandemic and the COVID slowdowns, supply chain disruptions. What I find most interesting is how we've come off these peaks and we're rolling over here. We're losing some momentum there, but that is to be expected as everything equalizes a little around the world. What we're saying that's different, and what I'm saying that's different, is that the normalization is going to return us to a lower level of general trade activity than existed pre-COVID. It's a bit of a roller coaster at the moment. Supply chain disruption means there's stockpiles that then have a swift boost and your trade number jumps again, etc. But overall, I do believe economic activity around the world is subdued and certainly below all the competition in Wall Street and in London and the major banks. All their forecasts of much stronger economic activity are really starting to fall over now. And we do need to be mindful that the world is long-term set back by the pandemic and these new disruptions and chip shortages and all those sorts of things. We can't expect some kind of nirvana economic recovery and outcome from where we are. That's a false belief, a false dawn. You should avoid that. Now, in Australia, we've had unemployment out today, and again at 4.2%, and that's quite a good number. I mean, that's nothing to sort of complain about, is it? It's almost full employment, though full employment could be closer to 3.5%, but it is almost full employment. I do think at 4.2%, there is no argument whatsoever for the RBA to still have interest rates at crisis levels, and I'm not going to go through all that again. You know how I feel about the RBA, the world's worst performing central bank, and even the OECD recommending an urgent review of the charter and the board. So hopefully something along those lines will eventually from our political leaders, because we certainly, as Peter Costello said, we certainly do need to hold the RBA accountable. It can't just sort of wing it out there with poor performance for the taxpayer paying them exorbitant salaries by even Federal Reserve standards. So, but unemployment 4.2%, that was good. Let's look at some markets. The euro. Now, the euro's had a very good rally. It's bouncing here. That's the daily chart. And, you know, we've had this volatility. And the euro's been, this fall in the euro just here has really been about the Russian-Ukraine situation. And will the European economy suffer from a reduction in energy supply, gas supply, or higher gas prices yet again coming out of Russia? And will Europe as a whole have some kind of economic slowdown if the sanctions themselves applied to Russia are too harsh and interfere with Europe-Russian trade? So that's the downside risk for the euro there that's eventuating there, plus the fact that you could have a war on your doorstep. I think the markets tried to recover here on the idea that war won't happen, and hopefully that is the case. But still, I'm still bearish the euro a little bit just for overall fundamental economic reasons, and I think people are going to be a little bit apprehensive moving forward, and they'll still want to have the safe haven of the US dollar. When we look at the Australian dollar, a similar story, but on the Australian dollar, we have seen a much stronger movement to the upside than I'd previously thought would be the case, certainly over the past week. We've seen the Australian dollar really kind of building further than I thought it would. I tend to think sell the Australian dollar here, but it is a little bit trickier. And remember, I've made this big forecast of 70 cents for the Aussie at 77, which was correct. Then I made a forecast for this year of 65 cents. And even myself, I'd have to say that if the Australian dollar moves much higher than where it is now, I could be wrong on that 65-cent call, but for the moment it is still very much in play because really we're just sort of to the top of the consolidation phase of the last several months here. So I'm thinking the Aussie dollar is going to tire into that resistance area there, 72 cents to 72.25.35, and then we'll get another down leg. And particularly if anything were to happen on the Ukraine front, that would materialize very quickly indeed. Speaking of those sorts of risk scenarios and safe havens, if we take a look at gold on the daily chart there, we can see gold's had a very strong sort of curving around acceleration. I do like the consolidation pattern of gold over the last few days. I think it is going to do some work here and continue higher. All throughout this period, the last 6 months, one of my constant mantras has been to steadily acquire gold. Not go in a big way, but just steadily accumulate positions in gold because of the long-term outlook. Now, for instance, I really want to show you this chart. This is the highlight of today's presentation, and that is the monthly gold chart. That is gold on a monthly chart. So that gives you an idea of the quantum level of what is happening here. This is a great trend and a massive consolidation phase. Absolutely so powerful. If you're any sort of student of historic price action, this looks like a market that could break to the upside, and that's why I've been saying since last year, forecast for gold this year is $2,500. Remember, I had that forecast even before there was any threat to Ukraine from Russia, so that could act as a catalyst to spur and accelerate my already existing forecast, but my forecast remains in place even if we get to see, hopefully, a situation of where the Ukraine crisis is fully resolved and we can be sure and confident of peace there. I still think that would cause a momentary slip in gold lower, but overall, gold would still be moving higher for reasons of industrial demand, jewelry, and as a store of value and a hedge against inflation, because inflation is here, inflation is going to stay strong. If we look at the US stock market, the US 500 index, that is a very weak recovery there. You know, we've had this idea that there could be peace for a moment. We've had this idea over the last 24 hours that the Fed minutes just released were a little bit dovish. I don't think they were, but a lot of the market commentary suggested they were. And yet still the market is stalling out after this couple of days of slight recovery from previous larger declines and more recent declines. I think the US stock market's in a lot of trouble. It's because of high valuations. I think the US economy is in a lot of trouble. You know, US consumer sentiment, retail sales picked up, but the trend's not really that outstanding. And US consumer sentiment, as we know for some time, has been plummeting. So we sort of take all that on board and we look at the AUS 200, the Australian stock market, and we can see that it's really been pushing to the upside. Certainly again, against my view over the last week in particular. But in Australia, we do have this kind of mentality of look past anything bad and just keep buying has been the Australian fund managers' mantra for some time. And I think the Australian market is about as bullish and as long as it can get. Certainly there's more funds out there wanting to buy. The market could move as high as sort of 74.25. But I think here around 73.45, 73.30, 73.45 where it is today is a potential top. If you see the Australian market tire in this level and you see the US market start to roll over, then the Australian market is going to be very vulnerable to some kind of squeezing of long positions that have been accumulated in the last few days. What I'm saying overall, to summarize, there's a mixture of economic data still, but overall the world's economic activity is subdued. China will pick up a little bit after the Olympics, but again, not to what it used to be. And I think that's the new normal. The new normal is below trend economic growth in most of the major economies with ever higher inflation and central banks that are way behind the curve and do need to catch up. Thank you very much. I'm Clifford Bennett, Chief Economist at ECY Securities. I hope you found this useful and you have a fabulous day. All the best.